Bernie Madoff stole $65 billion over 20 years. Sam Bankman-Fried collapsed a $32 billion empire in weeks. But 90 years before crypto, before hedge funds, before modern finance existed, one Italian immigrant with a third-grade education figured out how to steal $20 million in just 90 days, using nothing but postage stamps and pure charisma. Charles Ponzi didn't just commit fraud. He invented an entirely new category of crime so perfect, so mathematically elegant, that it still bears his name a century later. Every pyramid scheme, every investment scam, every too-good-to-be-true opportunity traces back to a cramped office in Boston where a 5-foot-tall dishwasher convinced Harvard professors, wealthy socialites, and street-smart cops to hand over their life savings. $20 million. In 1920, that's equivalent to $300 million today. He collected it faster than banks could count it. Investors lined up around city blocks. Police had to control the crowds. Newspapers called it Ponzi mania. But what nobody knew was that behind the mathematical genius, behind the confident smile and perfect suit, was a man who understood something darker about human nature than anyone before him. The scheme was so simple a child could understand it, so profitable that even when investigators proved it was impossible, people kept investing. So psychologically perfect that it fooled everyone from Italian immigrants desperate for a piece of America to Boston Brahmins who thought they were too sophisticated to be conned. This isn't just the story of history's first Ponzi scheme. It's the blueprint for every financial con that followed. The psychological manipulation tactics used by cryptocurrency scammers today. The mathematical impossibilities that still seduce brilliant people. The exact moment when American capitalism met its perfect predator. Charles Ponzi promised investors 50% returns in 45 days. For 8 months, he delivered. Until the day $20 million disappeared and thousands of families lost everything. But how did a man who arrived in America with $2.50 in his pocket convince an entire city to bet their futures on postal reply coupons? This is the story of the most perfectly crafted financial crime in history. December 1949. Charles Ponzi lies dying in a charity hospital in Rio de Janeiro. Broke, forgotten, partially paralyzed from a stroke. The man who once controlled millions sits in a ward for indigent patients, staring at the ceiling, whispering calculations about postal arbitrage to nurses who don't understand English. 49 years earlier, he'd stepped off a steamship at Ellis Island with nothing but $2.50, a rumpled suit, and an unshakable belief that America owed him everything. By 1920, he'd become the most famous man in Massachusetts, richer than the governor, more talked about than Babe Ruth. Newspapers across the world ran his photograph. Investors fought to give him money. The transformation defied every rule of economics, every law of mathematics, every principle of common sense. From dishwasher to millionaire in 8 months. From nobody to somebody faster than anyone in American history. But the climb up was nothing compared to the fall down. What most people don't know is that Charles Ponzi wasn't just a criminal. He was an innovator. Before him, financial fraud was crude, obvious, easily detected, fake companies, forged documents, strong-arm tactics. Ponzi understood something more sophisticated, that the greatest con isn't about lying to people, it's about letting them lie to themselves. His scheme worked because it was mathematically possible. Postal reply coupons did trade at different values in different countries. Currency arbitrage was a legitimate business. International mail regulations created genuine profit opportunities. For a brief moment in 1920, Charles Ponzi had discovered a legal way to print money. The problem was scale. The mathematics that worked for hundreds of dollars collapsed at millions, but Ponzi had learned something more valuable than mathematics in his years scraping by in America. People don't invest in opportunities, they invest in stories. And he told the most compelling story in financial history. Behind the success was a man haunted by failure. Ponzi had tried and failed at dozens of schemes before discovering postal coupons. Prison time in Canada, arrest for forgery in Atlanta, years of washing dishes, scrubbing floors, and watching successful men eat meals he couldn't afford. Each failure taught him something new about American weakness. This wasn't just about money, it was about respect. About proving that a short, balding Italian immigrant with a thick accent could outsmart Harvard graduates and Boston bankers. About transforming himself from the kind of person who served rich people into the kind of person rich people served. The timing was perfect. 1920. America was drunk on prosperity. The war was over. The economy was booming. Stock prices were rising. Regular people were getting rich for the first time in American history. Everyone had a get-rich-quick scheme. Everyone knew someone who doubled their money overnight. In that environment, 50% returns in 45 days didn't sound crazy. It sounded conservative. But to understand how one man convinced thousands of people to hand over their life savings based on a story about postal stamps, we need to go back to the beginning. To a 17-year-old kid stepping off a ship in 1903, looking at the New York skyline and making a promise to himself that would ultimately destroy hundreds of families. The greatest financial crime in American history started with the smallest dreams: a warm meal, a clean bed, and the chance to become someone America couldn't ignore. Let me take you back to November 1903, when Charles Ponzi first set foot on American soil and began learning the difference between the American dream and American reality. Chapter 1. Humble Arrival. November 3rd, 1903. The steamship Ivernia slides into New York Harbor carrying 1,900 passengers, most of them Italian immigrants clutching cardboard suitcases and addresses scribbled on scraps of paper. Among them stands Charles Ponzi, 17 years old, 5 feet 2 inches tall, wearing his only suit and carrying exactly $2.50 in his pocket. The money represents everything he owns in the world. His father, a postal worker in Parma, had scraped together enough for passage to America plus minimal survival funds. The plan was simple. Charles would work, save money, and send for the family. Millions of Italian immigrants had followed the same script. Most succeeded eventually. Charles Ponzi was different. As he shuffled through the immigration lines at Ellis Island, watching officials stamp papers and direct families toward tenement neighborhoods, he wasn't thinking about gradual success or patient saving. He was calculating, observing, learning how the system worked. The immigration officer asked his occupation. Student, Charles lied smoothly. In reality, he'd dropped out of school at 14 to work odd jobs around Parma. But student sounded more American, more legitimate, more like someone who deserved to be here. You see, Ponzi understood something that separated him from the other immigrants. America wasn't about working harder, it was about working smarter. While his fellow passengers worried about finding jobs and sending money home, Ponzi was studying the customs officials, watching how they decided who to question and who to wave through, learning the first lesson that would shape his entire criminal career. Confidence matters more than credentials. The train ride to Boston cost him 50 cents. His first meal in America cost 25 cents, a bowl of soup and bread at an Italian boarding house in the North End. That left him with $1.75 to start his American life. Most immigrants in his situation would panic. Ponzi saw opportunity. The boarding house was full of men who'd been in America for years, but still spoke broken English, still worked manual labor jobs, still sent most of their earnings back to Italy. They were honorable men following honorable paths, but they were also stuck. Ponzi decided immediately that he would not be stuck. His first job came within 2 days, dishwasher at a restaurant in downtown Boston. 12 hours a day, 6 days a week, for $5. The work was brutal, standing over steaming sinks, scrubbing grease off plates, dodging angry cooks, smelling like kitchen slop at the end of every shift. But it gave him something invaluable: access to successful Americans. Every night, Ponzi would position himself where he could watch the dining room through the kitchen doors. Wealthy Bostonians discussing business deals over expensive meals, lawyers arguing cases between courses, bankers comparing investment strategies over cigars and brandy. He couldn't hear the details, but he could observe the body language, the confidence, the casual way they handled money. Here's what's interesting. While other dishwashers gossiped about home or complained about work conditions, Ponzi studied these men like a scientist studying specimens: how they dressed, how they spoke, how they carried themselves, how they treated waiters, how they paid bills. Every detail was data for the person he planned to become. The transformation started small. Ponzi spent his first paycheck on a better suit, not new, but clean and well-fitted from a second-hand shop. He practiced English pronunciation in front of a broken mirror in his boarding house room, repeating phrases he'd heard in the restaurant until his accent softened. He bought a newspaper every morning and forced himself to read it, cover to cover, even when he didn't understand half the words. But observation wasn't enough. Ponzi needed to understand American business from the inside. After 3 months washing dishes, he convinced the restaurant owner to let him work as a waiter. The pay was worse initially. Waiters depended on tips, but the education was invaluable. Now he could hear the conversations, stock tips, real estate deals, import-export opportunities, political connections, bank loans, partnership agreements, corporate mergers. The wealthy men he'd been watching became his informal business school professors, teaching him American capitalism without knowing they had a student. Look, what made Ponzi different from other ambitious immigrants wasn't intelligence. Plenty of immigrants were smarter. It wasn't work ethic. Plenty worked harder. What made him unique was his complete lack of shame about starting at the bottom, combined with his absolute refusal to stay there. Most immigrants adapted to America gradually, preserving pieces of their old identity while slowly adopting new ones. Ponzi approached America like a performance. He studied successful Americans the way an actor studies a role, identifying specific behaviors to copy and specific mistakes to avoid. The breakthrough came during his 6th month as a waiter. A wealthy businessman named Harrison Peters was dining alone, complaining loudly about a failed investment in Canadian mining stocks. The company had promised huge returns, taken investors' money, and disappeared. Peters had lost $2,000, more money than Ponzi had seen in his entire life. But instead of sympathy, Ponzi felt excitement. Peters was rich, educated, sophisticated, and he'd been completely fooled by a simple investment scam. If wealthy Americans could be conned, then anyone could be conned. The key was understanding what wealthy people wanted to hear. That night, Ponzi wrote in his diary, "Americans are not smarter than Italians, they are just more confident about being stupid." The observation was harsh but accurate. American wealth in 1904 often came from speculation rather than production. Railroad investments, mining claims, real estate bubbles, currency arbitrage, complicated financial instruments that promised extraordinary returns with minimal risk. The entire economy was built on the principle that money could make money without anyone actually working. For a dishwasher turned waiter from Italy, this was revolutionary information. In Parma, wealth came from land, family businesses, or skilled trades, things you could see and touch. In America, wealth came from paper promises and mathematical calculations that most people didn't understand. Ponzi decided to stop washing dishes and start making promises. His first attempt at American entrepreneurship came in 1905, a plan to import Italian olive oil and sell it to Boston's growing Italian community. He'd noticed that good olive oil was expensive and hard to find in America. Italian families were paying premium prices for inferior products. The arbitrage opportunity seemed obvious. Using his savings and money borrowed from fellow immigrants, Ponzi placed orders with suppliers in Italy and arranged for shipping to Boston. The mathematics were simple. Buy oil for $1 per gallon in Italy, ship it to Boston for $2 per gallon in transportation costs, sell it for $6 per gallon retail. Pure profit of $3 per gallon. The first shipment arrived successfully. The oil was genuine, high quality, and priced competitively with existing imports. Italian families loved it. Orders started coming in. For 3 months, Ponzi seemed to have found his legitimate path to American success. Then the second shipment never arrived. The Italian supplier had taken Ponzi's money and disappeared. No oil, no refund, no explanation. The families who'd placed advance orders demanded their money back. Creditors came looking for loan payments. Within a week, Ponzi's olive oil empire collapsed completely. Most men would have returned to dishwashing, accepting the failure as a lesson in the dangers of ambitious thinking. But Ponzi had learned something more valuable than the olive oil business. Americans were willing to give money to people they barely knew, based on nothing but confidence and good storytelling. The failure wasn't devastating. It was educational. And the education was worth more than the money he'd lost. By 1906, Charles Ponzi had spent 3 years in America. He'd progressed from dishwasher to waiter to failed entrepreneur. His English was nearly perfect. His understanding of American business culture was sophisticated. His confidence was unshakable. He was ready to stop playing by other people's rules and start writing his own. The next phase of his education would take place in Canada, where he'd learn the difference between small-time fraud and professional crime. Chapter 2. Failed Dreams, Montreal, Canada. Summer 1907. Charles Ponzi stares at the brass nameplate on his desk. Assistant Manager, Zarossi Bank. At 25, he achieved something remarkable, a legitimate management position at a financial institution catering to Italian immigrants. Regular salary, clean office, respected title, everything he'd dreamed of when he left Italy. The problem was that Zarossi Bank was built on the exact same principles that would later define Ponzi's own scheme. Luigi Zarossi, the bank's founder, had discovered something brilliant about immigrant psychology. Italian workers in Montreal earned good wages but didn't trust Canadian banks. Language barriers, cultural differences, and suspicion of foreign institutions meant thousands of Italian immigrants kept their savings under mattresses or sent money back to Italy through informal networks. Zarossi offered a solution, an Italian-owned bank that spoke their language, understood their culture, and promised higher interest rates than Canadian institutions. 6% annual interest compared to 3% at regular banks. For desperate immigrants, the math was simple. Double your money's growth rate by banking with your own people. What the depositors didn't know was that Zarossi was using their savings to fund increasingly desperate investments, Canadian real estate speculation, mining claims, currency trading, high-risk ventures that promised huge returns but delivered consistent losses. The bank stayed afloat by attracting new depositors whose money paid the promised interest to existing customers. Sound familiar? Ponzi was learning the blueprint for his future empire by watching it happen in real time. His job was to greet customers, process deposits, and maintain the books that showed steady growth and healthy profits. Day after day, he watched Italian families trust their life savings to a man whose math didn't work. Week after week, he saw new depositors provide the cash flow needed to pay existing depositors their promised returns. But Ponzi didn't just observe the system, he improved it. His English skills and understanding of American business culture made him valuable to Zarossi, who spoke limited English and understood even less about Canadian banking regulations. Ponzi became the bridge between Zarossi's Italian vision and Canadian reality. Here's what's interesting. Ponzi could have exposed the scheme and saved hundreds of families from financial ruin. He understood the mathematics. He saw the unsustainable cash flows. He knew the promised returns were impossible, given the bank's actual investments. Instead, he decided to learn everything he could about running an impossible business. You see, Ponzi had identified a fundamental truth about immigrant communities that would define his entire criminal career. People who felt excluded from mainstream financial institutions were willing to accept higher risks in exchange for higher returns and cultural familiarity. Desperation plus ethnic loyalty equaled the perfect customer base for sophisticated fraud. The Zarossi Bank taught him 3 crucial lessons. First, confidence was more important than competence. Zarossi was a terrible businessman who lost money on almost every investment, but his absolute confidence in success convinced depositors to ignore obvious warning signs. Second, ethnic solidarity could override mathematical skepticism. Italian immigrants wanted to believe that fellow Italians would treat them fairly, even when the numbers suggested otherwise. Third, people would continue investing in failing schemes as long as early investors received promised returns. But the education was about to get more expensive. November 1908. Zarossi Bank faces a crisis. Too many depositors want their money at the same time. Not enough new deposits to cover withdrawals plus promised interest payments. The mathematical impossibility finally catches up with the charismatic promises. Zarossi panics and disappears, leaving Ponzi holding the books and facing angry crowds of Italian families demanding their savings. Most assistant managers would have called the police, declared bankruptcy, and started looking for new jobs. But Ponzi saw opportunity in the chaos. If he could somehow stabilize the bank's cash flow, he could take over Zarossi's role and run the scheme more efficiently. The plan was elegant. Forge a check from a wealthy Canadian businessman, deposit it into the bank's account, use the temporary cash infusion to pay demanding depositors, then find new investors to cover the forged check before anyone discovered the fraud. Simple, clean, a perfectly logical solution to an impossible mathematical problem. Ponzi forged a check for $423.58, a specific amount that seemed too precise to be fake, from a prominent Montreal businessman's account. He deposited it into Zarossi Bank, used the money to pay the most vocal depositors, and began looking for new investors to replace the stolen funds. For 3 days, the plan worked perfectly. Satisfied depositors spread word that the bank was solid. New customers started arriving. The cash flow crisis seemed manageable. Ponzi began imagining himself as the legitimate owner of a successful financial institution. Then, the forged check bounced. Canadian authorities moved quickly. Forgery was a serious crime, especially when it involved a prominent businessman and a bank serving immigrants. Ponzi was arrested, charged, and sentenced to 3 years in St. Vincent de Paul Penitentiary, one of Canada's toughest federal prisons. Prison was supposed to be punishment. For Ponzi, it became graduate school. St. Vincent de Paul housed some of Canada's most sophisticated criminals: stock manipulators, currency counterfeiters, insurance fraudsters, real estate scammers. Men who understood finance well enough to steal millions, but made mistakes small enough to get caught. In the yard, during meals, in work details, Ponzi listened to their stories and learned from their errors. The most important lesson came from a fellow inmate named Giuseppe the Professor Romano, serving time for an elaborate insurance fraud that had fooled investigators for years. Romano explained the difference between amateur crime and professional crime. Amateurs stole money, professionals borrowed it. When you steal, Romano explained, you create enemies. People want their money back. Police investigate. Prosecutors prosecute. But when you borrow money and pay generous returns to early investors, you create advocates. People defend your business because their profits depend on your success. The insight was revolutionary. Fraud didn't have to be adversarial. It could be collaborative. Instead of taking money from victims, you could convince victims to give you money willingly, enthusiastically, repeatedly. The key was making their success dependent on your success. Romano also taught Ponzi about the psychology of investigation. Authorities only pursued crimes when victims complained. If victims were making money, they didn't complain. If victims were making enough money, they actively discouraged investigation. The perfect crime wasn't invisible. It was profitable for everyone until it wasn't. Look, prison gave Ponzi 3 years to think, study, and plan. He read every book in the prison library. He learned about international finance, currency exchange, postal regulations, banking law, investment mathematics. He studied successful businessmen and successful criminals with equal intensity. Most importantly, he developed the patience and long-term thinking that his previous schemes had lacked. The man who entered St. Vincent de Paul was an impulsive opportunist who'd forged a check to solve an immediate problem. The man who left was a sophisticated strategist who understood that the best crimes were indistinguishable from legitimate businesses until the very end. Released in 1911, Ponzi immediately violated his parole by crossing the border into the United States illegally. He'd spent enough time in Canada. America remained the land of opportunity. He just needed to be smarter about finding his opportunities. But first, he had another lesson to learn. This one would take place in an Atlanta jail, where he'd discover that American authorities were just as serious about fraud as Canadian authorities, but American prisoners were far more sophisticated about avoiding capture. The brief illegal border crossing was detected by immigration officials in 1911. Instead of immediate deportation, Ponzi was sentenced to 2 years in an Atlanta federal prison for illegal re-entry. For most immigrants, this would have been the end of the American dream. For Ponzi, it was continuing education. Atlanta housed federal prisoners from across the American South, mail fraudsters, securities manipulators, currency counterfeiters, and most importantly, men who understood the psychology of American investment culture. Unlike Canadian criminals, who focused on simple theft, American criminals specialized in convincing people to voluntarily hand over money. The most influential mentor was a fellow inmate named Charles Morse, a former railroad magnate serving time for bank manipulation. Morse had controlled railroads, shipping companies, and banks across New England before his schemes collapsed. But even in prison, he commanded respect from both inmates and guards. Morse taught Ponzi about legitimate business structures that could hide illegitimate activities, how to create corporations, establish credit relationships, and build public reputations that made investigation more difficult, how to hire lawyers, accountants, and publicists who could defend business practices without understanding the underlying mathematics. Most importantly, Morse explained the concept of productive ambiguity, creating business models that were simultaneously legal and illegal, depending on interpretation. The greatest protection against criminal charges wasn't innocence, it was confusion about whether any crime had actually been committed. But the most valuable education came from studying fellow Italian inmates. Atlanta held dozens of Italian Americans who'd been caught running various scams in immigrant communities. Their stories revealed the same patterns Ponzi had observed in Montreal. Ethnic loyalty could override financial skepticism, but only temporarily. Eventually, mathematics defeated psychology. The solution wasn't abandoning ethnic community, it was expanding beyond ethnic community. If schemes failed because they ran out of Italian victims, the answer was finding non-Italian victims. If schemes collapsed because they couldn't sustain promised returns, the answer was finding legitimate ways to sustain promised returns, at least temporarily. By 1913, when Ponzi was finally released from Atlanta, he'd spent 6 years in American and Canadian prisons. Most men would emerge broken, bitter, and defeated. Ponzi emerged educated, confident, and ready to apply everything he'd learned. The criminal education was complete. The next phase would involve testing his theories in the real world. But first, he needed to become someone American authorities would trust. Someone whose success seemed legitimate until it was too late to stop. Someone who understood that the greatest fraud in American history would look exactly like the greatest business opportunity in American history. The transformation was about to begin. Chapter 3. Brilliant Discovery. Boston, Massachusetts, August 1919. Charles Ponzi sits in a cramped office above a grocery store on School Street, surrounded by rejection letters from potential employers and creditors demanding payment for his latest failed business venture. At 37 years old, he spent 16 years in America and has nothing to show for it except a criminal record, mounting debts, and a wife who's starting to question his promises of future wealth. Then, the mail arrives. Among the usual bills and collection notices is a single letter from Spain, a business correspondence that would accidentally reveal the mathematical loophole that would make Ponzi temporarily rich and permanently famous. The letter contains something Ponzi had never seen before, an international reply coupon. The coupon was a simple piece of paper, about the size of a dollar bill, issued by postal authorities to facilitate international correspondence. Someone in America could buy an international reply coupon for 5 cents, mail it to someone in Europe, who could then exchange it for enough local stamps to mail a letter back to America. The system was designed to eliminate the confusion of international postage rates and currency exchange. But Ponzi's criminal education had taught him to look for mathematical discrepancies in any system involving currency exchange. And this little piece of paper revealed the most extraordinary arbitrage opportunity he'd ever encountered. You see, international reply coupons were priced based on postal rates that had been fixed before World War I. But the war had caused massive inflation and currency devaluation across Europe. In Italy, for example, you could exchange $1 American for 6 times more lire than before the war. but international reply coupons still traded at pre-war exchange rates. Here's what that meant in practice. Ponzi could buy international reply coupons in Italy for the equivalent of 1 cent American, ship them to Boston, and redeem them for 5-cent American stamps, 5 cents profit on every penny invested, a 500% return. The mathematics were perfect. The opportunity was completely legal. The profit margins were extraordinary. And the system was backed by international postal authorities, making it as secure as government bonds. For the first time in his adult life, Charles Ponzi had discovered a way to make money that didn't involve fraud, forgery, or deception. He could become legitimately wealthy, using nothing but postal regulations and exchange rate discrepancies. But then he started calculating the practical limitations. To make serious money, say $1,000 per month, he'd need to process hundreds of thousands of coupons. That meant establishing purchasing agents in multiple European countries, arranging international shipping for massive quantities of paper, coordinating currency exchange across different banking systems, and physically redeeming thousands of coupons at American post offices. The logistical complexity was staggering. The startup capital requirements were enormous. The time lag between investment and return was months, and the profit margins, while impressive on paper, might disappear once transaction costs, shipping delays, and currency fluctuations were factored in. Most importantly, postal authorities could change the regulations at any time, eliminating the arbitrage opportunity instantly. All of that infrastructure, all of those relationships, all of those complicated international transactions, they could become worthless overnight with a single regulatory adjustment. For a legitimate businessman, these limitations would have been discouraging. For Charles Ponzi, they were irrelevant, because Ponzi had learned something in prison that legitimate businessmen never learned. People don't invest in actual opportunities, they invest in stories about opportunities. The international reply coupon scheme gave him the greatest story in financial history. It was mathematically sound, government-backed, internationally verified, and completely legal. It solved a real problem using sophisticated knowledge of postal regulations and currency exchange. It was exactly the kind of complicated but logical business that impressed intelligent people. But here's the genius. Ponzi didn't need to actually run the international reply coupon business at scale. He just needed to convince investors that he was running it at scale. He could raise money from investors, pay them generous returns using new investors' money, and explain the returns by referencing his postal arbitrage profits. The beauty was that the business model was too complex for casual investigation. How many people understood international postal regulations? How many could verify currency exchange rates across multiple countries? How many knew enough about arbitrage mathematics to check his calculations? Even if investigators suspected fraud, they'd need to prove that international reply coupon arbitrage was impossible. But it wasn't impossible. It was just impractical at the scale Ponzi was claiming. The difference between impossible and impractical was the perfect camouflage for the perfect crime. Look, what made this scheme revolutionary was that it started with a legitimate business opportunity and evolved into sophisticated fraud without any clear moment of transition. Ponzi could honestly tell investors that he'd discovered a legal way to profit from postal regulations. He could accurately describe the mathematics of international arbitrage. He could correctly explain why currency devaluation created profit opportunities. Every claim was technically true. The fraud was in the scale, not the concept. December 1919. Ponzi officially launched the Securities Exchange Company from his cramped office on School Street. The business plan was elegantly simple. Investors would loan money to the Securities Exchange Company, which would use the funds to purchase international reply coupons in Europe, ship them to America, redeem them for stamps, sell the stamps at retail value, and return the profits to investors. The promised return was 50% profit in 45 days. Invest $100 today, receive $150 in 6 weeks. Invest $1,000, receive $1,500. The mathematics seemed conservative given the 500% profit margins from postal arbitrage and the time frame allowed for international shipping delays. But Ponzi needed to start carefully. His criminal record made him vulnerable to investigation. His lack of capital made large-scale operations impossible. His immigrant status made some Americans naturally suspicious of his business promises. The solution was to begin with the Italian community in Boston's North End. These were people who knew him personally, understood his background, and had cultural reasons to support a fellow Italian's business venture. If the scheme succeeded with Italian investors, word-of-mouth advertising would eventually bring in American investors with deeper pockets. His first investor was Ettore Ghiberti, a fellow Italian immigrant who worked as a furniture finisher. Ghiberti had saved tender, a significant amount for someone earning 50 lans per week, and needed it to grow quickly so he could bring his wife over from Italy. The 50% return in 45 days would accelerate his family reunification plans by months. Ponzi took Ghiberti's $10, walked to the nearest post office, bought 2 international reply coupons to demonstrate the legitimacy of his business model, then used the remaining $9 to pay rent and buy food. There was no European purchasing operation, no international shipping, no large-scale arbitrage, just $10 that needed to become $15 in 6 weeks. The solution was obvious: find another investor. 2 weeks later, Ponzi convinced Roberto Amighi, a barber from the North End, to invest $20 in the Securities Exchange Company. Ponzi used $15 of Amighi's money to pay Ghiberti his promised return and kept $5 to cover operating expenses. Ghiberti was ecstatic. 50% profit in 30 days, exactly as promised. He immediately reinvested his $15 plus another $10 of savings. More importantly, he told every Italian in the North End about Ponzi's postal coup business that actually worked. You see, this was the crucial moment when legitimate opportunity became sophisticated fraud. Ponzi had transitioned from using international reply coupons to using Ettore Ghiberti. Instead of profiting from postal arbitrage, he was profiting from investor psychology. Instead of trading stamps, he was trading confidence, but the transition was seamless, invisible, and mathematically elegant. Ghiberti received exactly the returns Ponzi had promised. The payment schedule matched international shipping timeframes. The business explanation remained consistent and logical. If you'd asked Ponzi whether he was running a legitimate business or a criminal enterprise, he could honestly answer both. The third investor was Maria Boselli, who'd heard about Ponzi's success from Ghiberti's wife. She invested $50, a huge sum for an Italian immigrant family, and began telling her customers about the amazing postal coupon business that was making everyone rich. By February 1920, word was spreading through the Italian community faster than Ponzi could process new investors. Men were borrowing against their homes to invest with him. Families were combining savings to qualify for larger investments. Second-generation Italian Americans who worked in American banks and insurance companies were vouching for the mathematical soundness of postal arbitrage. But success created new problems. As more investors demanded returns, Ponzi needed exponentially more new investors to pay them. The mathematics of any Ponzi scheme are brutal. Paying 150% return requires finding 1.5 new investors of the same size. Paying 10 50% returns requires finding 15 new investors. Paying 100 returns requires finding 150 new investors. Growth wasn't optional, it was mandatory for survival. March 1920. Ponzi realizes that the Italian community isn't large enough to sustain his promised returns. He needs American investors with American bank accounts and American social connections. He needs people who can bring in serious money without asking too many questions about postal regulations or European currency markets. The transition required changing his image from Italian immigrant businessman to American financial expert. Better clothes, better office, better explanations that emphasized sophisticated mathematics rather than ethnic solidarity. Most importantly, he needed early American investors who were prominent enough that their success would attract others. Doctors, lawyers, bankers, politicians, people whose participation would validate the Securities Exchange Company for mainstream American investors. The hunt for American credibility was about to begin, and Ponzi had learned enough about American psychology to know exactly what story successful Americans wanted to hear. The brilliant discovery phase was complete. The brilliant deception phase was about to begin. Chapter 4. Perfect Pitch. February 26, 1920. Charles Ponzi walks into the Hanover Trust Company on Washington Street wearing a $300 suit, more money than most Boston workers earned in 2 months, and carrying a leather briefcase that contains $38,000 in cash. The bank manager, Henry Chmielinski, has never seen this short, well-dressed Italian man before, but the money in the briefcase commands immediate attention and respectful service. Ponzi opens an account under the name Securities Exchange Company and makes it clear that this is just the beginning. He expects to be depositing substantial amounts regularly, very substantial. He speaks with quiet confidence about international business opportunities and postal arbitrage. He mentions casually that his investment methods are producing returns that American bankers would find interesting. What Chmielinski doesn't know is that the $38,000 represents every dollar Ponzi has collected from Italian investors over the previous 3 months. Instead of investing the money in international reply coupons, Ponzi has decided to invest it in something more valuable: credibility. The bank account transforms him from a small-time ethnic businessman into a serious American financial operator. But the real stroke of genius was in choosing Hanover Trust specifically. It was a respected institution, but small enough that a $38,000 account would make him an important customer. Important customers get personal attention from bank managers. Bank managers talk to other bank managers. Other bank managers talk to their important customers. Within 2 weeks, word was spreading through Boston's financial community about a mysterious Italian businessman who discovered an extraordinary investment opportunity involving international postal regulations. The details were vague, but the bank account was real, and Ponzi was accepting new investors. Here's what made Ponzi's pitch perfect. It combined mathematical sophistication with emotional psychology in a way that appealed to different types of investors for different reasons. For educated investors, doctors, lawyers, accountants, Ponzi emphasized the technical aspects of postal arbitrage. He'd spread out international reply coupons on his desk, explained currency exchange mathematics, and walked through the logistics of international mail systems. The complexity was impressive. The profit margins were conservative compared to the arbitrage opportunity. The regulatory framework was government-backed and internationally recognized. These investors left meetings convinced that they'd discovered a brilliant businessman who'd identified a legitimate loophole in postal regulations. They felt smart for recognizing a sophisticated opportunity that others had missed. For working-class investors, barbers, construction workers, grocery store owners, Ponzi emphasized the simplicity and security of his system. 50% return in 45 days. Government backing. No risk of business failure because postal systems weren't going anywhere. Simple math that anyone could understand. These investors left meetings convinced that they'd found a way to get rich without having to understand complicated business deals. They felt lucky for meeting someone willing to share a sure thing with regular people. But Ponzi's real innovation was in understanding American investment psychology in the aftermath of World War I. The war had made many Americans suspicious of foreign business opportunities while simultaneously making them confident about American superiority in international markets. Ponzi's pitch addressed both concerns perfectly. The suspicion was handled by emphasizing that his opportunity exploited European economic weakness for American benefit. Currency devaluation in Italy and Germany created arbitrage opportunities that smart American investors could profit from. The scheme literally involved taking advantage of European problems to make American money. The confidence was reinforced by positioning postal arbitrage as a patriotic investment. Ponzi explained that he was bringing European wealth back to America through superior knowledge of international regulations. His profits weren't just personal success. They were American economic victory over European competitors. You see, this psychological framework transformed a simple investment pitch into something much more powerful. A way for investors to feel smart, patriotic, and financially successful simultaneously. They weren't just buying into a business opportunity. They were joining a sophisticated American operation that was outsmarting the rest of the world. March 1920. Ponzi's first major American investor was Dr. Joseph Daniels, a prominent Boston physician who'd heard about the Securities Exchange Company through his banker at Hanover Trust. Daniels had $5,000 to invest, more money than Ponzi had ever handled from a single investor. But Daniels wasn't just bringing money, he was bringing credibility. When a respected doctor vouched for an investment opportunity, other professionals took notice. When Dr. Daniels received his promised returns exactly on schedule, other doctors started asking questions about this mysterious postal arbitrage business. The demonstration effect was everything Ponzi had hoped for. Daniels received $7,500 after 45 days, a clean 50% return that he could verify with his own bank account. But more importantly, Daniels became an advocate. He told colleagues about his extraordinary returns. He vouched for Ponzi's credibility. He explained the postal arbitrage mathematics to anyone who'd listen. But here's what Dr. Daniels didn't know. His $7,500 return hadn't come from international reply coupons. It had come from Antonio Salvati, Maria Boselli, and 12 other Italian immigrants who'd invested with Ponzi in the weeks after Daniels made his initial investment. The beautiful thing was that Daniels' success encouraged other American professionals to invest larger amounts, which provided the cash flow needed to pay returns to the Italian investors who'd made Daniels' returns possible. Everyone was getting paid exactly as promised, exactly on schedule. The mathematics worked perfectly as long as new investments exceeded required return payments, and new investments were accelerating. By April 1920, Ponzi had refined his pitch into a presentation that could adapt to any audience while maintaining consistent core messages. The key was reading potential investors quickly and emphasizing the aspects of postal arbitrage that would appeal to their specific psychology. Conservative investors heard about government backing and regulatory stability. Aggressive investors heard about extraordinary profit margins and limited competition. Patriotic investors heard about American economic superiority and European exploitation. Suspicious investors heard detailed mathematical explanations and technical documentation. But every investor heard the same promise: 50% returns in 45 days, backed by international reply coupon arbitrage. The promise was psychologically perfect because it was ambitious enough to be exciting, but conservative enough to be believable. 50% in 45 days translated to roughly 400% annual returns. Extraordinary, but not impossible given the 500% profit margins from postal arbitrage. The time frame was long enough to seem legitimate, but short enough to prevent extensive investigation. Most importantly, the returns were specific and consistent, not up to 50% or approximately 45 days, or, depending on market conditions, exactly 50% profit in exactly 45 days, every time, guaranteed. Look, the specificity was crucial for building trust. Vague promises sounded like scams. Specific promises sounded like business plans. When Ponzi told investors that their money would grow by exactly 11.11% every 10 days, the precision suggested sophisticated mathematical modeling rather than arbitrary guesswork. April 1920 marked Ponzi's transition from small-scale operator to major financial phenomenon. Word was spreading beyond Boston's Italian and professional communities to ordinary middle-class Americans who'd heard rumors about an amazing investment opportunity that was making everyone rich. The office on School Street couldn't handle the volume of interested investors. Lines were forming outside the building. People were bringing friends, family members, and business associates to meet the remarkable businessman who discovered a way to beat the banks. Ponzi realized he needed to scale his operations to match demand. Better office, more staff, professional presentation materials that would impress sophisticated investors while remaining accessible to working-class customers. But most importantly, he needed to maintain the careful balance between promoting growth and avoiding unwanted attention. Too little growth, and he couldn't pay promised returns. Too much growth, and he'd attract regulatory investigation. The solution was to position the Securities Exchange Company as an exclusive opportunity for informed investors rather than a mass-market investment. Instead of advertising publicly, Ponzi would rely on word-of-mouth recommendations from satisfied customers. Instead of accepting every potential investor, he'd be selective about who qualified for his postal arbitrage opportunity. The psychology was brilliant. Exclusivity made people want access. Selectivity made approval feel like an achievement. Limited availability created urgency. When investors had to qualify for the privilege of giving Ponzi their money, they stopped asking skeptical questions and started hoping for acceptance. May 1920. The Securities Exchange Company moved to elegant offices at 27 School Street, complete with mahogany furniture, professional staff, and a private office where Ponzi could meet with major investors. The rent was $300 per month, more than most American families earned, but the image was essential for attracting serious money. The new office featured maps of Europe showing postal systems, charts explaining currency exchange rates, and examples of international reply coupons from different countries. Everything an investor needed to see to understand the sophistication and legitimacy of postal arbitrage. But the most important feature was Ponzi himself. By May 1920, he'd transformed his appearance and demeanor to match American expectations of financial success. Perfect suits, confident bearing, fluent English with only a slight accent that suggested European sophistication rather than immigrant status. When investors met Charles Ponzi in his impressive office, surrounded by international business documentation, discussing complex currency mathematics with casual expertise, they saw exactly what they expected to see: a brilliant businessman who discovered an opportunity that others had missed. The perfect pitch was working perfectly. Money was flowing in faster than Ponzi could count it. Returns were being paid exactly as promised. Word-of-mouth advertising was bringing in new investors daily. Everything was proceeding according to plan. Until the plan started working too well, and success created the one problem Ponzi hadn't anticipated: how to manage more money than any Ponzi scheme in history had ever attempted to handle. The machine was built. Now it needed to prove it could run at an unprecedented scale. Chapter 5. Money Machine, June 1920. Charles Ponzi arrives at his office to find 300 people standing in line outside 27 School Street. The line stretches around the block. Boston police have been called to manage crowds. Newspaper reporters are interviewing investors. The Securities Exchange Company has become the biggest story in Boston. Inside the office, Ponzi's staff is overwhelmed. Clerks are processing investment applications as fast as they can write receipts. Cash boxes are overflowing. The safe is packed with more money than the Hanover Trust Company holds in its vaults. In a single day, Ponzi collects $440,000 in new investments, more money than most American businesses earn in a year. This is what success looks like when it happens too fast to control. The previous month had been a dream. Satisfied investors telling friends about their extraordinary returns, word-of-mouth advertising bringing in steady streams of new customers. Returns being paid exactly on schedule. The Securities Exchange Company operating like a perfectly calibrated machine that converted confidence into cash. But June changed everything. What had been manageable growth became explosive mania. Instead of processing dozens of investors per week, Ponzi was processing hundreds per day. Instead of handling thousands of dollars, he was handling hundreds of thousands of dollars. The scale had exceeded every projection, every plan, every mathematical model. You see, Ponzi had built his scheme to grow steadily and sustainably. The Italian community phase was supposed to last months. The professional expansion phase was supposed to take a year. The mainstream adoption phase was supposed to be gradual and controlled. Instead, Boston had discovered the Securities Exchange Company all at once. And when an entire city decides that something is the opportunity of a lifetime, rational planning becomes impossible. The crowd started forming at dawn. Working-class families who'd saved for years to buy homes were withdrawing their savings to invest with Ponzi. Middle-class professionals were borrowing against their businesses to qualify for larger investments. Wealthy socialites were liquidating stock portfolios to participate in postal arbitrage. The demographic range was extraordinary. Italian immigrants stood next to Harvard professors. Boston Brahmins lined up behind Irish construction workers. Everyone from grocery store clerks to bank presidents wanted access to the Securities Exchange Company. But here's what made the situation both incredible and impossible. Every single investor was owed specific returns on specific dates. Ponzi wasn't just collecting money. He was accumulating thousands of individual obligations that would come due over the next 45 days. The mathematics were becoming brutal. If Ponzi collected $440,000 on June 1st, he owed $660,000 by July 16th. If he collected another $500,000 on June 2nd, he owed another $750,000 by July 17th. Every day of extraordinary success created exponentially larger obligations for the future. Traditional businesses could handle sudden demand increases by raising prices, expanding capacity, or limiting supply. But Ponzi's promise was non-negotiable: 50% returns in 45 days for every investor, regardless of timing or volume. The only solution was to keep growing faster than the obligations accumulated. If June brought in $2 million in new investments, July would need to bring in $3 million to pay June's returns, plus July's promises. August would need $4.5 million. September would need $6.75 million. Look, the progression was mathematically inevitable. Unless Ponzi could somehow transition from promised returns to actual returns, unless postal arbitrage could actually generate the millions needed to pay investors, the scheme would eventually collapse under the weight of its own success. But for now, the machine was working. Money was flowing in. Returns were being paid. Investors were happy. Ponzi was becoming famous, and fame brought new problems. June 15, 1920, the Boston Post published the first major newspaper story about Charles Ponzi and his remarkable investment success. The article was generally positive, highlighting his impressive returns, his sophisticated understanding of international finance, and the enthusiasm of his satisfied investors. But the article also asked questions that no one had previously asked in print. How could postal arbitrage generate enough profit to sustain 50% returns? Why weren't other financial institutions exploiting the same opportunity? What would happen if postal regulations changed? Ponzi had expected media attention eventually, but he'd planned to control the narrative by building relationships with financial reporters, demonstrating the legitimacy of postal arbitrage, and positioning himself as an innovative businessman rather than a controversial figure. Instead, the Boston Post article framed the Securities Exchange Company as a mystery that needed investigation rather than a success that deserved celebration. The tone was respectful but skeptical, and skepticism was dangerous for any business that depended entirely on confidence. Ponzi's response was characteristically bold. Instead of avoiding additional media attention, he courted it. He invited reporters to visit his office, observe his operations, and interview his staff. He provided detailed explanations of postal arbitrage, complete with mathematical examples and regulatory documentation. Most importantly, he allowed reporters to witness the daily crowds of satisfied investors collecting their promised returns. Every day at 3 p.m., dozens of people lined up to receive checks for 50% more than they'd invested 45 days earlier. The reporters could see the money, count the returns, and interview the happy investors. The demonstration was psychologically perfect. Skeptical questions about theoretical mathematics seemed less important when confronted with actual people receiving actual money. Whatever the Boston Post's concerns about postal arbitrage, the evidence was clear. Charles Ponzi was paying exactly what he promised, exactly when he promised it. June brought another innovation: mass media marketing. Ponzi began placing advertisements in Boston newspapers, explaining the Securities Exchange Company opportunity to readers across New England. The ads were carefully written to emphasize legitimacy while creating urgency. Securities Exchange Company offers investors the opportunity to profit from international reply coupon arbitrage. Our proven system generates consistent returns through sophisticated understanding of postal regulations and currency exchange. Limited partnerships available for qualified investors. Consistent 50% returns in 45-day cycles. Government-backed security. Expert management. Apply today. The advertisements worked too well. Instead of attracting steady streams of new investors, They created additional crowds that overwhelmed Ponzi's expanded staff and office space. The success was becoming unmanageable. By late June, the Securities Exchange Company was collecting more than $1 million per week. Ponzi had to hire additional clerks, rent additional office space, and arrange additional banking relationships to handle the volume of cash flowing through his operation. But the real problem wasn't logistical, it was mathematical. The exponential growth meant that Ponzi's obligations were approaching the point where no conceivable business could generate enough profit to meet them. To pay July returns, Ponzi would need to earn approximately $3 million in profit from international reply coupon arbitrage. But the entire global market for international reply coupons was worth less than $1 million annually. There literally weren't enough coupons in the world to generate the profits Ponzi needed. You see, this was the moment when Ponzi's scheme transitioned from impractical to impossible. The early investors could theoretically have been paid from postal arbitrage profits. The current investors could only be paid from future investors. And future investors could only be paid from even more future investors. The machine had become too successful for its own mathematical foundation. July 1920. Ponzi realizes that his greatest asset, explosive growth, has become his greatest liability. The crowds outside his office are attracting unwanted attention from financial regulators, postal authorities, and federal investigators. Success at this scale was impossible to hide and difficult to explain. The solution was to create the appearance of deliberate, controlled expansion rather than runaway growth. Ponzi began limiting the number of new investors he'd accept per day. He raised minimum investment amounts to reduce the administrative burden of processing small accounts. He hired professional staff to create a more business-like atmosphere. But most importantly, he began developing contingency plans for the inevitable investigation that would come when the mathematical impossibility became obvious to authorities. The key was time. If Ponzi could delay serious investigation for a few more months, he could accumulate enough money to either attempt legitimate postal arbitrage at unprecedented scale or disappear to a country without extradition treaties. But delay required maintaining absolute confidence among investors, staff, and media. Any sign of doubt, any hint of trouble, any suggestion that the returns weren't sustainable would trigger the panic that would end everything. Ponzi decided to double down on confidence. Instead of preparing for failure, he would act as if failure was impossible. Instead of planning escape routes, he would plan expansion strategies. Instead of limiting growth, he would accelerate growth. The decision was psychologically brilliant and mathematically insane. But Charles Ponzi had learned something in his 17 years in America that served him well. Americans were more impressed by absolute confidence than mathematical accuracy. If he could convince Boston that the Securities Exchange Company was too successful to fail, maybe success would somehow solve the mathematical problems that made failure inevitable. July brought the greatest test yet. $5 million in new investments in a single month, money flowing in faster than banks could process deposits, returns being paid to thousands of investors simultaneously. The Securities Exchange Company operating at a scale that surpassed many legitimate banks. The machine was working perfectly, until the day someone asked the question that would expose the mathematical impossibility underlying the entire operation. If postal arbitrage was so profitable, why wasn't Charles Ponzi buying international reply coupons? Chapter 6. Lifestyle Excess. July 4, 1920. Charles Ponzi stands on the mahogany deck of his newly purchased yacht, watching Boston Harbor fireworks explode overhead, while 50 of the city's most prominent citizens celebrate Independence Day as his personal guests. The yacht cost $15,000, more money than most Americans would earn in a lifetime. The champagne being served costs more per bottle than his guests earn per week. 6 months earlier, Ponzi had been living in a rented room above a grocery store, dodging creditors and washing dishes to survive. Now he owned the most luxurious yacht in Boston Harbor, employed a personal staff of 12, and commanded more ready cash than the city's oldest banks. The transformation wasn't just financial, it was social. The same Boston Brahmins who would have crossed the street to avoid an Italian immigrant were now competing for invitations to his parties. Harvard professors sought his advice on international finance. Politicians courted his endorsements. Newspaper editors treated his opinions as front-page news. But the lifestyle excess served a purpose beyond personal satisfaction. Every display of wealth was a marketing tool. Every luxury purchase was evidence that postal arbitrage was generating exactly the profits Ponzi claimed. When investors saw his mansion, his yacht, his automobiles, they saw proof that the Securities Exchange Company was the most successful business in Massachusetts. The mansion came first. Ponzi purchased a 20-room estate in Lexington for $35,000 cash. No mortgage, no financing, just a briefcase full of bills handed to the previous owner. The house featured marble staircases, crystal chandeliers, Persian rugs, and a library stocked with leather-bound books on international finance and postal regulations. But the most important feature was the location. Lexington was where Boston's old money families maintained their country estates. By purchasing property there, Ponzi was claiming membership in Massachusetts aristocracy. The message was clear. Postal arbitrage had made him wealthy enough to live among people who'd inherited their wealth for generations. The automobile collection was equally strategic. Ponzi owned a locomobile, a Pierce Arrow, and a custom Rolls-Royce, each more expensive than the average American home. But he didn't just own them. He drove them to investor meetings, parked them outside his office, and loaned them to prominent Bostonians who could spread word about his generosity. You see, each car was a mobile advertisement for the Securities Exchange Company. When Harvard professors saw Ponzi arriving at business meetings in a Rolls-Royce, they didn't question postal arbitrage. They wondered how to increase their investments. The staff was chosen for maximum social impact. Ponzi hired graduates from prestigious universities as his assistants, former bank executives as his advisors, and prominent socialites as his secretaries. When investors visited his office, they were greeted by people who looked and sounded like the American elite. But the real genius was in the parties. Ponzi hosted elaborate social events that brought together his investors with Boston's most influential citizens. Italian immigrants found themselves dining with Harvard deans. Working-class investors shared cigars with bank presidents. Everyone who attended left convinced that the Securities Exchange Company was the most exclusive opportunity in Massachusetts. The parties served multiple purposes simultaneously. They demonstrated Ponzi's wealth and social connections. They allowed investors to network with each other, creating a sense of community around postal arbitrage. They provided opportunities for satisfied investors to recruit new investors. And they generated newspaper coverage that enhanced Ponzi's reputation as a successful businessman. Most importantly, the parties created what psychologists call social proof, the tendency for people to validate their decisions based on other people's behavior. When investors saw hundreds of intelligent, successful people participating in postal arbitrage, their doubts disappeared. If Harvard professors and bank presidents were investing with Ponzi, who were they to question the mathematics? But the lifestyle excess was expensive. The mansion cost $5,000 per month to maintain. The yacht required a crew of 6. The automobiles needed custom maintenance. The staff demanded professional salaries. The parties cost thousands of dollars each. By July 1920, Ponzi was spending more than $20,000 per month on personal expenses, money that could otherwise have been used to pay investor returns. But he understood something that other criminals missed. Spending money on lifestyle wasn't waste, it was investment in credibility. Look, every dollar Ponzi spent on luxury convinced investors that postal arbitrage was generating enormous profits. The mansion proved that he was making millions. The yacht demonstrated that he was confident about future earnings. The parties showed that he was accepted by legitimate society. If Ponzi had lived modestly, investors would have wondered where the profits were going. If he'd saved money instead of spending it, people would have suspected that the returns weren't as large as claimed. The excess wasn't selfishness, it was psychology. July 15, 1920. Ponzi throws the most elaborate party in Boston's social history. 500 guests, orchestra music, imported champagne, catered dining for Boston's political, financial, and social elite. The event costs $15,000, more than most Americans earned in 10 years. The guest list was a masterpiece of social engineering. Mayor James Michael Curley attended, lending political credibility. Harvard Business School professors provided academic validation. Bank presidents offered financial legitimacy. Newspaper publishers ensured favorable coverage. But the most important guests were Ponzi's investors. Hundreds of ordinary Americans who'd trusted their savings to postal arbitrage were celebrating alongside the city's most prominent citizens. The message was unmistakable. Investing with Ponzi wasn't just profitable, it was a path to social elevation. The party featured something unprecedented in Boston social history. Ponzi publicly thanked his investors for their trust and announced that the Securities Exchange Company would guarantee its 50% returns indefinitely. No time limits, no market conditions, no regulatory changes. Postal arbitrage would continue generating extraordinary profits as long as people wanted to participate. The announcement was psychologically perfect and mathematically insane. It eliminated the urgency that might have caused investors to withdraw their money while creating absolute confidence that the returns would continue forever. It positioned Ponzi as so successful that he could make guarantees that no legitimate business could offer. But guaranteeing 50% returns indefinitely meant that Ponzi's obligations would compound exponentially forever. If current investors reinvested their returns, their accounts would double every 90 days. $1,000 would become $2,000, then $4,000, then $8,000, then $16,000. Within 2 years, early investors would be millionaires. The mathematics weren't just impractical, they were physically impossible. There wasn't enough money in Massachusetts to pay the returns Ponzi was promising. There wasn't enough money in America. There wasn't enough money in the world. But the party guests didn't care about mathematics. They cared about being part of the most successful financial phenomenon in Boston history. They cared about the social elevation that came with backing Charles Ponzi. They cared about the 50% returns that were making them wealthy. The evening ended with Ponzi announcing his engagement to Rose Necco, a beautiful Italian-American woman from a respected Boston family. The engagement was another masterstroke of image management. Marriage to an established Boston family would complete his transformation from immigrant outsider to American insider. But the announcement also served a practical purpose. Married men seemed more stable and trustworthy than bachelors. Family men were less likely to disappear with investor money. Men with local wives had community ties that discouraged criminal behavior. The wedding was planned for August, providing another opportunity for elaborate celebration and favorable publicity, another chance to demonstrate wealth and social acceptance, another tool for building confidence in the Securities Exchange Company. August 1920. The wedding of Charles and Rose Ponzi became Boston's social event of the year. 600 guests. St. Anthony's Cathedral filled with flowers. Reception at the Copley Plaza Hotel. Coverage in every Boston newspaper. The guest list represented the complete spectrum of Massachusetts society. Italian immigrants who remembered when Ponzi washed dishes celebrated alongside Harvard professors who now sought his investment advice. Working-class families who'd become wealthy through postal arbitrage dined with Boston Brahmins, whose ancestors had arrived on the Mayflower. But the most important aspect of the wedding was the gifts. Investors competed to give Ponzi the most expensive presents, demonstrating their gratitude for the wealth he'd provided and their confidence in future returns. The gifts totaled more than $100,000, a fortune that represented the collective appreciation of thousands of satisfied customers. The wedding coverage emphasized Ponzi's transformation from immigrant to American success story. The newspapers described him as a brilliant businessman who discovered opportunities that others had missed. They praised his generosity, his intelligence, and his commitment to sharing his success with ordinary Americans. What the newspapers didn't mention was the mathematical impossibility that was becoming obvious to anyone who calculated the actual requirements for sustaining 50% returns at the scale Ponzi was operating. By August 1920, the Securities Exchange Company held more than $15 million in investor funds. To pay promised returns, Ponzi would need to generate $7.5 million in profit every 45 days. That required purchasing and processing approximately 150 million international reply coupons annually. The problem was that fewer than 30 million international reply coupons were issued globally each year. Ponzi would need to control 5 times the entire world supply to generate the profits he was promising. But the lifestyle excess continued. The mansion grew more elaborate. The parties became more extravagant. The automobile collection expanded. The staff multiplied. Every display of wealth convinced investors that postal arbitrage was working exactly as promised. Charles Ponzi had created the perfect illusion, a lifestyle so successful that questioning its foundation seemed impossible, until the day someone finally did the mathematics. Chapter 7. Cracks appear July 26, 1920. Boston Post financial reporter Clarence Barron sits in a cramped newspaper office surrounded by financial documents and postal regulations, trying to solve a puzzle that's been bothering him for weeks. The numbers don't add up. Charles Ponzi claims to be generating millions in profit from international reply coupon arbitrage, but Barron's investigation into global postal systems suggests this is mathematically impossible. Barron had been watching the Securities Exchange Company with growing skepticism since June. The crowds outside Ponzi's office were impossible to ignore. The 50% returns seemed too good to be true. But most concerning was Ponzi's reluctance to provide specific details about his international operations. You see, Barron wasn't just any financial reporter. He was the founder of Barron's Financial Weekly, one of America's most respected investment publications. He understood international finance better than most bank presidents, and he knew enough about postal systems to recognize when someone was making claims that couldn't possibly be true. The investigation began with a simple question: how many international reply coupons would Ponzi need to purchase to generate the profits he was claiming? The mathematics were straightforward. Ponzi claimed to earn 5 cents profit per coupon through currency arbitrage. To generate $1 million in monthly profits, he'd need to process 20 million coupons. To sustain operations at current scale, he'd need to handle approximately 60 million coupons annually. But according to the International Postal Union, fewer than 27,000 international reply coupons were sold globally in 1919. Not 27 million, 27,000. The entire world market wasn't large enough to support a single month of Ponzi's claimed operations. Barron's discovery was devastating. There was no possible way that international reply coupon arbitrage could generate the profits needed to sustain 50% returns at the scale Ponzi was operating. The business model wasn't just impractical, it was physically impossible. But Barron was a careful journalist. Before publishing accusations that could destroy a man's reputation, he decided to give Ponzi an opportunity to explain the discrepancy. August 2, 1920. Clarence Barron visits the Securities Exchange Company offices on School Street, requesting an interview with Charles Ponzi about his international postal operations. Ponzi, confident in his ability to charm any investigator, agrees to meet with Boston's most respected financial journalist. The meeting was a disaster for Ponzi. Barron asked specific questions about coupon purchasing procedures, currency exchange mechanisms, and international shipping logistics. Ponzi's answers were vague, contradictory, and obviously evasive. When Barron asked to see documentation of Ponzi's European purchasing operations, Ponzi claimed that business confidentiality prevented him from sharing trade secrets. When Barron asked about the volume of coupons being processed, Ponzi deflected by emphasizing the sophistication of his arbitrage mathematics. Most damaging was Ponzi's inability to explain how he was processing 60 million coupons annually when the global market was 27,000 coupons. Ponzi suggested that Barron's information about international postal statistics was incomplete, but couldn't provide alternative data to support his claims. Barron left the meeting convinced that the Securities Exchange Company was a massive fraud that would eventually collapse and devastate thousands of investors. He returned to his office and began writing the story that would expose Charles Ponzi as a criminal rather than a financial genius. But Barron faced a professional dilemma. His investigation proved that Ponzi's claimed business model was impossible, but it didn't prove that Ponzi was intentionally defrauding investors. Maybe Ponzi genuinely believed that postal arbitrage could work at large scale. Maybe he was mistaken rather than malicious. The distinction mattered because false accusations against innocent businessmen could destroy reputations and trigger lawsuits. Barron needed to be absolutely certain that Ponzi was running a deliberate fraud rather than a mistaken business venture. The solution was to investigate Ponzi's background. If Ponzi had a history of financial crimes, it would support accusations of deliberate fraud. If his background was clean, it might suggest honest mistakes rather than criminal intent. August 5, 1920. Barron's background investigation uncovers Charles Ponzi's criminal history. Prison time in Canada for forgery, conviction in Atlanta for illegal border crossing, years of failed business ventures and unpaid debts, a pattern of financial fraud stretching back 15 years. The discovery transformed Barron's story from financial analysis to criminal expose. Ponzi wasn't a mistaken businessman. He was a career criminal using sophisticated psychological manipulation to steal millions from trusting investors. But Barron's investigation also revealed something else. Postal authorities and federal regulators had been quietly monitoring the Securities Exchange Company for weeks. Government investigators had reached the same conclusions about the mathematical impossibility of Ponzi's claims. Official action was being planned. Barron realized that his story would be more than journalism. It would be the trigger that brought down the largest financial fraud in American history. August 11, 1920. The Boston Post publishes Clarence Barron's investigation under the headline, "Questions about Ponzi's Postal Profits." The story is carefully written to present facts rather than accusations, but the implications are devastating. Barron explained the mathematics of international reply coupon arbitrage, demonstrated the limited size of global postal markets, and questioned how Ponzi could be processing volumes of coupons that exceeded world production by 2,000%. The story suggested that either Ponzi was mistaken about the scale of his operations, or investors were being misled about the source of their returns. The article avoided calling Ponzi a criminal, but any reader who understood mathematics could reach only one conclusion. The Securities Exchange Company was paying investor returns with investor money, not postal profits. Ponzi's response was characteristically aggressive. Instead of addressing Barron's mathematical concerns, he attacked Barron's credibility and the Boston Post's motives. He suggested that established financial institutions were using media manipulation to destroy innovative competition. More importantly, Ponzi announced that the Securities Exchange Company would temporarily suspend accepting new investments while conducting an internal audit to address questions about international operations. The suspension was presented as a voluntary measure to satisfy critics, but investors interpreted it as a sign of trouble. You see, this was the moment when confidence began cracking. Ponzi's strength had always been absolute certainty about his ability to pay promised returns. The suspension suggested uncertainty, and uncertainty was poison for any business that depended entirely on psychology. August 12, 1920, lines form outside the Securities Exchange Company offices, but now they're investors demanding withdrawals rather than seeking new investments. The same crowds that had demonstrated Ponzi's success were now evidence of panic. Ponzi tried to maintain confidence by continuing to pay returns to investors whose 45-day cycles had matured. Throughout the day, he handed out thousands of dollars to satisfied customers, demonstrating that the Securities Exchange Company remained financially sound despite media criticism. But the mathematics were becoming impossible. Paying returns without accepting new investments meant that cash was flowing out without flowing in. Ponzi's reserves were being depleted at the same time that future obligations were coming due. By evening, Ponzi had paid out $2 million while collecting nothing. His cash reserves were nearly exhausted. Unless new investments resumed immediately, he wouldn't be able to pay the returns scheduled for the following week. The suspension that was supposed to buy time had instead accelerated the crisis. Ponzi needed to choose between admitting failure and taking desperate measures to restore confidence. He chose desperation. August 13, 1920. Ponzi announces that the Securities Exchange Company audit has been completed and that international postal operations are proceeding exactly as promised. The temporary suspension is lifted. New investments are being accepted immediately. But more importantly, Ponzi makes an unprecedented guarantee. Any investor who wants immediate withdrawal of their principal plus promised returns can receive payment instantly, regardless of their investment timeline. No waiting periods, no processing delays, no questions asked. Oh, the guarantee was psychologically brilliant and financially suicidal. It demonstrated absolute confidence in the company's financial strength while creating impossible obligations that guaranteed eventual collapse. Hundreds of investors took Ponzi up on his offer. Throughout the day, he paid out massive sums to anyone who demanded immediate settlement. By evening, he'd disbursed more than $5 million, money that had taken months to accumulate through new investments. But the demonstration worked. Investors who witnessed Ponzi paying millions on demand were convinced that his financial strength was unlimited. Word spread that the Securities Exchange Company was so profitable that it could pay everyone immediately if necessary. New investments resumed. The lines outside School Street returned to their previous enthusiasm. The crisis seemed to pass as quickly as it had developed. What investors didn't know was that Ponzi had used every dollar of company reserves to create the impression of unlimited wealth. The Securities Exchange Company was now technically bankrupt, operating entirely on the assumption that new investments would provide the cash flow needed to pay future obligations. August 15, 1920. Federal postal inspectors arrive at the Securities Exchange Company offices with warrants to investigate international reply coupon transactions. They're not investigating potential fraud. They're investigating actual violations of postal regulations and international mail laws. The inspection was devastating. Postal inspectors found fewer than $100 worth of international reply coupons in Ponzi's possession. No evidence of large-scale European purchasing operations, no documentation of international shipping arrangements, no records of currency exchange transactions. Most damaging was the discovery that Ponzi had purchased his small supply of coupons from local Boston post offices rather than international sources. The sophisticated arbitrage operation was actually a handful of stamps bought at retail prices from neighborhood postal workers. The postal inspection proved conclusively that the Securities Exchange Company was not engaged in international reply coupon arbitrage at any meaningful scale. Whatever was generating investor returns, it wasn't postal profits. But Ponzi still had one final card to play. As long as he could convince investors that government investigation was politically motivated harassment rather than legitimate law enforcement, he might be able to maintain confidence until he could figure out an escape strategy. The greatest con in American history was about to face its greatest test. Could Charles Ponzi convince thousands of Americans that the United States government was wrong about mathematics? Chapter 8. Chapter 8. Total Collapse. August 18, 1920. Massachusetts Bank. Commissioner Joseph Allen strides into the Securities Exchange Company offices at 27 School Street with a team of accountants, armed with legal authority to seize all records and freeze all assets. The investigation that began with mathematical curiosity has become a full-scale law enforcement operation. For Charles Ponzi, this moment represents the end of the greatest financial deception in American history. But he doesn't act like a defeated criminal. As investigators box up financial records and count cash reserves, Ponzi remains confident, charming, and absolutely convinced that he can talk his way out of the mathematical impossibility that has finally caught up with him. Allen's audit team works through the night, calculating the true financial condition of the Securities Exchange Company. The numbers are devastating. Ponzi owes investors approximately $7 million in promised returns. His total assets, cash, bank accounts, real estate, automobiles, everything, are worth approximately $2 million. The deficit is staggering. Even if every single asset were liquidated immediately at full value, investors would lose more than $5 million, but liquidation would take months, during which time additional returns would come due. The actual losses would be even larger. But here's what made the situation truly unprecedented. Most of the investors still believed in Charles Ponzi. Despite government investigation, despite mathematical proof that postal arbitrage couldn't work at scale, despite the obvious impossibility of their returns, thousands of people remained convinced that Ponzi was a legitimate businessman being persecuted by jealous authorities. You see, Ponzi had created something more powerful than a financial scheme. He'd created a community of believers. For 8 months, his investors had watched their money grow exactly as promised. They'd received returns that banks said were impossible. They'd participated in the most successful investment opportunity in Massachusetts history. That success created psychological investment that transcended mathematical proof. When authorities claimed that postal arbitrage couldn't generate the promised returns, investors didn't question Ponzi. They questioned the authorities. When bank commissioners said the numbers didn't add up, investors assumed the commissioners were protecting established financial institutions from innovative competition. The loyalty was so strong that many investors continued trying to give Ponzi money even after his assets were frozen. They stood outside his offices, demanding that authorities stop interfering with their investment decisions. They organized petition drives supporting Ponzi's right to conduct business. They raised money for his legal defense. August 20, 1920. Massachusetts authorities issue arrest warrants for Charles Ponzi on charges of mail fraud, securities fraud, and criminal conspiracy. But when federal agents arrive at his Lexington mansion to make the arrest, they find Ponzi calmly finishing breakfast with his wife, completely unsurprised by their presence. The arrest was almost anticlimactic. Ponzi had known for days that government investigation would eventually lead to criminal charges. He'd used the time to arrange affairs, secure legal representation, and prepare his final public statement about the Securities Exchange Company. But even under arrest, Ponzi remained defiant. He told reporters that postal arbitrage was a legitimate business being destroyed by government interference. He claimed that his investment methods were so successful that established banks had lobbied for regulatory action to eliminate competition. Most remarkably, he promised that investor funds were secure and that returns would resume once legal difficulties were resolved. Even facing federal criminal charges, Ponzi continued promoting the Securities Exchange Company as a viable investment opportunity. The courthouse scenes were extraordinary. Hundreds of investors gathered to show support for Ponzi during his arraignment. They cheered when he appeared. They booed prosecutors and federal agents. They chanted demands that authorities release their money and allow them to make their own investment decisions. The support wasn't just emotional, it was financial. Prominent investors posted his bail. Others hired expensive attorneys for his defense. Working-class families who'd invested their savings with Ponzi contributed to legal funds, even though they'd already lost their original investments. But while Ponzi maintained his public defiance, the mathematics of his scheme were becoming clear to everyone involved. Bank Commissioner Allen's audit revealed the stunning scope of the fraud. The Securities Exchange Company had collected approximately $15 million from roughly 40,000 investors over 8 months. Of that $15 million, approximately $8 million had been paid out as returns to earlier investors. Administrative expenses, lifestyle costs, and legitimate business operations had consumed another $1 million. That left approximately $6 million that had simply disappeared, not invested in postal arbitrage, not lost in business operations, not stolen by employees, simply gone, spent by Ponzi on maintaining the illusion that had convinced thousands of people to trust him with their life savings. The human cost was devastating. Families had mortgaged their homes to invest with Ponzi. Immigrants had sent money they'd saved for years to bring relatives to America. Small business owners had emptied their operating accounts to participate in postal arbitrage. Maria Boselli, the Italian immigrant woman who'd been one of Ponzi's early investors, had convinced her entire extended family to invest their combined savings of $3,000, money that represented years of sacrifice and the foundation for their American dreams. When the scheme collapsed, 3 generations of the Boselli family were financially ruined. Dr. Joseph Daniels, the prominent physician who'd been Ponzi's first major American investor, had eventually invested more than $50,000, his life savings plus money borrowed against his medical practice. The collapse forced him to sell his home and declare bankruptcy. Look, these weren't naive or unsophisticated people. They were intelligent Americans who'd been convinced by a mathematically elegant story that perfectly exploited their desire for financial security and social advancement. They'd been victims of the most sophisticated psychological manipulation in criminal history. August 25, 1920. As federal prosecutors prepare their case against Charles Ponzi, investigators make a discovery that explains how one man convinced thousands of people to ignore obvious mathematical impossibilities. Ponzi had been right about postal arbitrage. International reply coupon arbitrage was a legitimate business opportunity. Currency devaluation after World War I had created genuine profit opportunities in international mail systems. Small-scale postal arbitrage was not only possible, it was profitable. The problem was scale. Ponzi's mistake wasn't identifying the opportunity, it was believing he could scale a small opportunity into a large business without changing the fundamental mathematics. A legitimate postal arbitrage business might have generated 20% annual returns on investments of a few $1,000s, but Ponzi had promised 400% annual returns on investments of $15 million. The scale had transformed a legitimate opportunity into a mathematical impossibility. The discovery was important for understanding how Ponzi had maintained his own confidence throughout the scheme. He wasn't just a cynical criminal lying to investors, he was a criminal who'd convinced himself that his lies were true. Ponzi genuinely believed that postal arbitrage could work at large scale. He'd convinced himself that government investigation was politically motivated rather than mathematically necessary. He'd created a reality where his success was so obvious that questioning it seemed absurd. The self-deception was psychologically sophisticated and criminally devastating. Because Ponzi believed his own story, he could sell it with absolute conviction. Because he was convinced that postal arbitrage would eventually solve his mathematical problems, he continued accepting investments long after any rational criminal would have disappeared with the money. September 1920. The trial of Charles Ponzi becomes the most closely watched criminal proceeding in Massachusetts history. Newspapers across America cover every detail. Radio stations broadcast trial updates. Newsreel cameras document the proceedings for cinema audiences nationwide. But the trial revealed something unexpected. Many investors still supported Ponzi even after the mathematical proof of fraud was presented in court. They testified on his behalf. They argued that his methods were legitimate. They demanded that authorities return their money so they could reinvest with him. The loyalty was so strong that prosecutors worried about jury tampering. Several jurors received anonymous letters threatening violence if they voted to convict. Others received offers of money to vote for acquittal. The trial lasted 6 weeks and featured testimony from postal experts, banking authorities, international finance specialists, and hundreds of investors. The evidence was overwhelming. The mathematics were incontrovertible. The fraud was undeniable. Charles Ponzi was convicted on all charges and sentenced to 5 years in federal prison plus deportation to Italy upon release. But even conviction didn't end the story. Many investors continued believing that Ponzi was innocent, that postal arbitrage was legitimate, and that government authorities had destroyed a successful business to protect established financial institutions. The delusion persisted for years. Some investors never accepted that their money was gone. They continued waiting for Ponzi's vindication and the restoration of their accounts. December 1920. As Charles Ponzi sits in federal prison, investigators continue discovering the scope of his psychological manipulation. The scheme hadn't just stolen money, it had created a financial cult whose members remained loyal even after their leader's conviction. The final accounting was devastating. Of the $15 million collected by the Securities Exchange Company, investors recovered approximately $3 million through asset liquidation. The remaining $12 million was gone forever. But the real legacy wasn't financial, it was psychological. Charles Ponzi had demonstrated that sophisticated fraud could convince intelligent people to ignore mathematical reality. He'd proved that the right combination of confidence, complexity, and community could sustain impossible promises until the very end. The collapse of the Securities Exchange Company marked the end of innocence for American investment culture. Never again would Americans trust financial opportunities without demanding mathematical proof. Never again would promises of extraordinary returns go unexamined. But never again would American criminals underestimate the power of the psychological techniques that Charles Ponzi had perfected in a cramped office above a Boston grocery store. The greatest financial fraud in American history was over. Its influence on future fraudsters was just beginning. Chapter 9, Legal Reckoning, February 17, 1925. Charles Ponzi walks out of Plymouth Federal Prison wearing a cheap suit provided by prison authorities and carrying $17 in release money. He served 3 years and 8 months of his 5-year sentence, earning time off for good behavior and cooperation with federal investigators, studying his scheme. But freedom is temporary. Immigration authorities are waiting outside the prison gates with deportation orders. After 22 years in America, Charles Ponzi is being sent back to Italy as an undesirable alien whose presence threatens public safety. The deportation hearing is brief and inevitable. Ponzi's criminal conviction makes him ineligible for American citizenship or permanent residence. His immigration status has been revoked. He has 30 days to arrange passage to Italy or face indefinite detention. For most deportees, this would be devastating. Ponzi sees it as opportunity. Italy in 1925 is experiencing economic growth and political change under Mussolini's new government. An American businessman with experience in international finance might find opportunities that don't exist for convicted criminals in the United States. But first, Ponzi has unfinished business in America. During his prison years, he'd received hundreds of letters from former investors. Some were angry, demanding restitution for their losses. Others were supportive, expressing continued belief in his innocence and postal arbitrage. Most interesting were the letters from new admirers who wanted to learn his methods. You see, prison had transformed Charles Ponzi from a failed criminal into a criminal celebrity. His scheme had been studied by law enforcement agencies, business schools, and financial institutions. Books were being written about his psychological techniques. Newspapers regularly printed stories about Ponzi schemes in other cities. The notoriety was valuable. Fame meant opportunity. And Ponzi had learned enough about American business culture to know that even criminal fame could be converted into legitimate profit. His plan was elegant. Spend a few months in America writing a book about his experiences, selling the story to magazines and newspapers, and licensing his name for business ventures. Use the proceeds to establish a legitimate business in Italy, possibly involving legitimate international arbitrage opportunities. The plan seemed reasonable until Ponzi discovered that Massachusetts authorities had additional charges pending against him. State prosecutors had been waiting for his federal release to pursue state-level fraud charges that could result in decades of additional prison time. March 1925. Ponzi is arrested again, this time by Massachusetts State Police on charges of grand larceny, operating a fraudulent investment scheme, and violating state banking regulations. The charges are more serious than his federal convictions because Massachusetts considers him a habitual offender with a pattern of financial crimes. But Ponzi has spent his prison years studying law, developing legal strategies, and building relationships with prominent defense attorneys who are fascinated by his case. His defense team argues that federal prosecution and state prosecution constitute double jeopardy, punishment for the same crime by different authorities. The legal argument is sophisticated but unsuccessful. Federal charges involved mail fraud and interstate commerce violations. State charges focus on theft and securities fraud within Massachusetts. The courts rule that both prosecutions are legally valid. The second trial is different from the first. Public interest has faded. Media coverage is minimal. Former investors have moved on with their lives. Charles Ponzi is no longer a fascinating celebrity. He's a career criminal facing inevitable conviction. But Ponzi's defense strategy is more sophisticated than during his first trial. Instead of claiming innocence, he argues diminished responsibility. He presents psychiatric evidence suggesting that his belief in postal arbitrage was so strong that he genuinely didn't understand he was committing fraud. The psychiatric defense is innovative for 1925. Ponzi's attorneys argue that he suffered from grandiose delusions, that made him incapable of distinguishing between legitimate business and criminal fraud. They claim he was mentally ill rather than criminally malicious. Look, the defense was psychologically sophisticated and legally groundbreaking. If successful, it would have established precedent for treating financial fraud as mental illness rather than criminal intent. But Massachusetts courts weren't ready for psychiatric defenses in white-collar crime cases. Ponzi is convicted again and sentenced to 7 to 9 years in state prison. Combined with deportation orders, the sentence effectively ends any possibility of returning to America or building legitimate business opportunities. But Ponzi refuses to accept defeat. During his state appeals process, he escapes from Massachusetts custody and disappears for several months. The escape generates national headlines and demonstrates that, even facing additional prison time, Charles Ponzi remains capable of sophisticated planning and execution. June 1925. Ponzi is recaptured in New Orleans, attempting to board a ship bound for Italy under a false name. The escape attempt adds additional charges to his growing legal problems, but also generates new media attention and public interest in his story. The recapture reveals something important about Ponzi's psychology. He genuinely believes that he can restart his life in Italy and build legitimate success using the skills he'd developed in America. Even facing decades in prison, he remains confident that his experience and notoriety can be converted into business opportunities. The confidence isn't entirely delusional. Several Italian businessmen have contacted him about potential partnerships. Publishers in Rome are interested in his memoirs. Even some American investors have suggested that they'd be willing to fund legitimate ventures if Ponzi could somehow clear his legal problems. But the legal problems are becoming insurmountable. Federal authorities want him deported. Massachusetts authorities want him imprisoned. Immigration authorities want him detained indefinitely. There's no legal path that leads to freedom and opportunity. September 1925. Ponzi agrees to a plea arrangement that will resolve all his American legal problems simultaneously. He'll plead guilty to state charges, serve 7 years in Massachusetts prison, then accept immediate deportation to Italy with no possibility of return. The plea agreement represents defeat, but it also provides certainty. Instead of fighting legal battles for years while imprisoned, Ponzi can serve his time and begin planning his Italian future. But prison is harder the second time. Ponzi is now 43 years old in declining health and facing the reality that his American dream has become an American nightmare. The confidence that sustained him through previous difficulties is finally beginning to crack. The worst part isn't the physical conditions, it's the psychological isolation. During his first imprisonment, Ponzi had been a celebrity criminal whose case generated widespread interest. During his second imprisonment, he's forgotten. Former investors have rebuilt their lives. Media attention has moved to new scandals. Charles Ponzi is learning the difference between fame and notoriety. Fame provides opportunities. Notoriety eventually fades into obscurity. 1932. After serving 7 years in Massachusetts state prison, Charles Ponzi is released directly into immigration custody for immediate deportation to Italy. He's 50 years old in poor health and owns nothing except the clothes provided by prison authorities. The deportation ship journey gives Ponzi time to plan his Italian future. He studied international business opportunities during his prison years. He understands currency exchange markets better than most legitimate businessmen. He has connections with Italian-American business communities who might provide funding for legitimate ventures. Most importantly, he has something that no other businessman in Italy possesses: detailed knowledge of American investment psychology and the specific techniques that convince people to trust strangers with their money. The knowledge is valuable even for legitimate businesses. Understanding investor psychology is useful for raising capital, building partnerships, and developing customer relationships. Ponzi's criminal education could be converted into legitimate business advantage. But Italy in 1932 is experiencing economic depression and political instability. Mussolini's government is becoming increasingly authoritarian. International business opportunities are limited. American investment capital is scarce. The country Ponzi had left 30 years earlier no longer exists. The opportunities he'd planned to exploit have disappeared. The connections he'd hoped to develop are unavailable. Within 6 months of his return to Italy, Charles Ponzi realizes that his American experience has made him unsuitable for Italian life. His accent is wrong. His business methods are alien. His expectations are unrealistic. He's too American for Italy and too Italian for America. Too criminal for legitimate business and too old for criminal business. Too famous for anonymity and too infamous for respectability. The man who'd once convinced thousands of Americans to trust him with their life savings can't convince a single Italian bank to give him a loan for legitimate business. 1934. Charles Ponzi attempts one final scheme, a land development project in Rio de Janeiro that promises to transform Brazilian jungle into profitable farmland for European investors. The mathematics are familiar: extraordinary returns from limited investments using sophisticated knowledge of international regulations. The Brazilian scheme attracts some Italian investors, but collapses within months when it becomes clear that the promised land doesn't exist and the Brazilian government hasn't authorized foreign development. Ponzi is arrested by Brazilian authorities, convicted of fraud, and sentenced to prison in Rio de Janeiro. At 52 years old, he's back where he started, imprisoned for financial fraud in a foreign country, far from home, with no realistic prospects for legitimate success. The Brazilian prison sentence marks the end of Charles Ponzi's criminal career. He's too old, too sick, and too well known to attempt additional schemes. His notoriety prevents legitimate employment. His health problems prevent physical labor. For the first time since arriving in America in 1903, Charles Ponzi has no plan, no scheme, and no confidence that his situation can be improved through intelligence and determination. The man who'd once convinced America that anything was possible has finally learned that some things are impossible, even for him. Chapter 10. Modern Legacy. December 7, 1941. Pearl Harbor. As America enters World War II, federal investigators studying wartime financial crimes discover something disturbing. Charles Ponzi's scheme has been replicated dozens of times across the United States, with criminals using his exact psychological techniques to defraud Americans investing in war bonds and defense industries. The Securities Exchange Company had become a blueprint. Law enforcement agencies report Ponzi schemes in Chicago, Detroit, Los Angeles, and Miami. The methods are identical: promise extraordinary returns, pay early investors with new investors' money, use mathematical complexity to discourage investigation, maintain absolute confidence until inevitable collapse. But the imitators are making the same mistakes Ponzi made. They're scaling legitimate opportunities beyond mathematical possibility. They're confusing temporary success with permanent viability. They're believing their own lies until reality forces recognition of mathematical impossibility. What the imitators don't understand is that Ponzi's scheme worked not because of postal arbitrage, but because of psychological manipulation. The postal coupons were irrelevant. The currency mathematics were camouflage. The real innovation was convincing intelligent people that mathematical impossibility was sophisticated opportunity. You see, Charles Ponzi had accidentally discovered something profound about human psychology. People want to believe in opportunities that seem too good to be true, especially when those opportunities are explained by smart-sounding people using complicated-sounding methods. The lesson should have been that extraordinary returns require extraordinary skepticism. Instead, the lesson learned by criminals was that extraordinary returns could be promised as long as they were backed by extraordinary stories. 1960s. Wall Street experiences a series of investment scandals that investigators describe as sophisticated Ponzi schemes. Instead of postal coupons, the new schemes involve international currency trading, computer technology, and offshore banking. The methods change, but the psychology remains identical. Bernie Kornfeld's Investors Overseas Services promises extraordinary returns through innovative mutual fund management. The mathematics depend on continuous growth in new investors. When growth slows, the fund collapses and investors lose hundreds of millions of dollars. The pattern is becoming clear. Every generation of financial criminals rediscovers Charles Ponzi's psychological techniques and applies them to contemporary opportunities. Technology changes, but human greed and gullibility remain constant. But the schemes are also becoming more sophisticated. Modern criminals have access to Ponzi's prison writings, academic studies of his methods, and detailed analysis of why the Securities Exchange Company succeeded for 8 months before collapsing. They're learning from his mistakes, using computer systems to manage complex accounting, employing legal teams to navigate securities regulations, hiring public relations firms to manage media coverage, building international operations to complicate law enforcement investigation. The result is Ponzi schemes that last longer, steal more money, and destroy more lives than Charles Ponzi ever imagined possible. 1980s. The emergence of sophisticated financial instruments creates new opportunities for Ponzi-style fraud. Junk bonds, leveraged buyouts, and derivatives trading provide mathematical camouflage for schemes that would have been obviously impossible in Charles Ponzi's era. Michael Milken builds a financial empire based on junk bonds that promise extraordinary returns through innovative risk management. The empire collapses when investigators discover that the promised returns depend on continuous expansion rather than actual profits. Ivan Boesky manipulates securities markets using insider information and complex trading strategies. His methods generate consistent profits until law enforcement realizes that the strategies are mathematically unsustainable. The common thread connecting modern financial scandals to Charles Ponzi's 1920 scheme is the use of complexity to hide mathematical impossibility. Whether the complexity involves postal regulations, computer algorithms, or derivatives mathematics, the psychology remains the same. Confused investors are trusting investors, but modern schemes are operating at scales that would have been incomprehensible to Charles Ponzi. Instead of thousands of investors losing millions of dollars, contemporary schemes involve millions of investors losing billions of dollars. 1990s. The internet creates new possibilities for reaching potential investors and new methods for creating psychological manipulation. Online investment opportunities can reach global audiences instantly. Digital marketing can target specific psychological profiles with customized persuasion techniques. The result is a proliferation of Ponzi schemes that combine Charles Ponzi's psychological methods with contemporary technology. Instead of meeting investors face-to-face, modern criminals build websites that create the impression of sophisticated international operations. But the fundamental challenge remains the same: how to convince rational people that mathematical impossibilities are business opportunities. The internet makes it easier to reach potential victims, but it doesn't solve the mathematical problems that eventually destroy all Ponzi schemes. 2008. Bernie Madoff's investment empire collapses during the financial crisis, revealing the largest Ponzi scheme in history. Madoff had stolen approximately $65 billion from investors over 20 years using methods that Charles Ponzi would have recognized immediately. The Madoff scheme combined every psychological technique that Ponzi had pioneered: exclusive access that made investors feel privileged, mathematical complexity that discouraged investigation, consistent returns that seemed too conservative to be fraudulent, social proof from respected investors who vouched for the scheme's legitimacy. But Madoff had advantages that Ponzi never possessed: decades of legitimate business reputation, regulatory relationships that discouraged investigation, technology that enabled sophisticated accounting fraud, international operations that complicated law enforcement coordination. The result was a scheme that lasted 10 times longer than Ponzi's and stole more than 1,000 times more money. Look, the comparison between Ponzi and Madoff reveals how little has changed in the fundamental psychology of financial fraud. The same techniques that convinced Boston immigrants to trust their savings to postal arbitrage convinced Wall Street sophisticates to trust their fortunes to mathematical impossibilities. The only real difference was scale. Ponzi's scheme collapsed after 8 months and $15 million in losses. Madoff's scheme continued for 20 years and caused $65 billion in damage. 2020s. Cryptocurrency and social media create new opportunities for Ponzi-style schemes that can reach global audiences instantly and operate across international boundaries with minimal regulatory oversight. FTX, the cryptocurrency exchange founded by Sam Bankman-Fried, collapses when investigators discover that customer deposits have been used to pay returns to earlier investors and fund lavish lifestyles. The scheme combines Charles Ponzi's psychological techniques with contemporary cryptocurrency technology. The pattern is becoming predictable. Every new technology creates new opportunities for old psychological manipulation. Whether the technology involves postal coupons, computer algorithms, or cryptocurrency, the fundamental human weaknesses that Charles Ponzi identified remain exploitable. But contemporary schemes operate in a global financial system that Ponzi could never have imagined. Instead of stealing from a single city, modern criminals can steal from multiple countries simultaneously. Instead of manipulating hundreds of investors, they can manipulate millions. The globalization of finance has globalized the potential impact of Ponzi schemes. When FTX collapsed, it affected investors in dozens of countries and contributed to a worldwide cryptocurrency crisis. Today, financial regulators around the world study Charles Ponzi's scheme as the foundational example of investment fraud. Securities laws, banking regulations, and international financial agreements all include provisions designed to prevent the kind of psychological manipulation that Ponzi perfected in 1920. But the regulations are always reactive, designed to prevent the last scheme rather than anticipate the next one. Criminals continue discovering new applications for Ponzi's psychological techniques, new technologies that can hide mathematical impossibilities, and new investors who want to believe in opportunities that seem too good to be true. The fundamental lesson of Charles Ponzi's life isn't about postal coupons or international arbitrage. It's about the eternal tension between human greed and mathematical reality. As long as people want extraordinary returns without extraordinary risks, someone will be willing to promise the impossible. The name Ponzi scheme has become shorthand for any investment fraud that pays existing investors with new investors' money. But the psychological techniques that Charles Ponzi pioneered extend far beyond financial fraud. Political movements use Ponzi's confidence-building methods to convince supporters that impossible promises are realistic policies. Marketing campaigns use his social proof techniques to convince consumers that product claims are verified by satisfied customers. Social media influencers use his exclusivity tactics to convince followers that access to information is a privilege rather than a right. Charles Ponzi died in poverty in Brazil in 1949, forgotten by the world and abandoned by the people he'd once convinced to trust him. But his legacy lives on in every impossible promise that sounds possible when explained by confident people using complicated methods. The greatest financial criminal in American history had discovered something more valuable than money: the psychological techniques that convince rational people to act irrationally. And those techniques continue working today, exactly as they worked in a cramped office in Boston more than 100 years ago. So we've seen how a 5-foot-tall dishwasher from Italy convinced thousands of Americans to hand over $15 million based on a story about postage stamps and pure mathematical impossibility. We've watched Charles Ponzi build the most sophisticated financial fraud in history using nothing but confidence, complexity, and the fundamental human desire to believe in opportunities that seem too good to be true. But the real story isn't about Charles Ponzi. It's about us. Today, 100 years after the collapse of the Securities Exchange Company, Americans lose billions of dollars annually to investment schemes that use the exact psychological techniques Ponzi pioneered. The technology changes: cryptocurrency instead of postal coupons, social media instead of word-of-mouth marketing, global finance instead of local banking. But the fundamental psychology remains identical. We want to believe in extraordinary opportunities. We want access to exclusive investments. We want mathematical complexity to be evidence of sophisticated strategy rather than sophisticated deception. We want confident explanations of impossible returns because confident explanations make impossible returns seem possible. The uncomfortable truth is that Charles Ponzi succeeded because he understood American psychology better than Americans understood themselves. He recognized that intelligence and education don't protect against psychological manipulation. They just change the type of manipulation that works. Harvard professors fell for postal arbitrage mathematics. Bank presidents vouched for currency exchange theories. Newspaper editors promoted international trade opportunities. The same intelligence that made them successful in legitimate businesses made them vulnerable to illegitimate businesses that sounded logical. But here's what's really disturbing. Every person who invested with Charles Ponzi had access to the information needed to recognize that his scheme was mathematically impossible. Postal regulations were public documents. Currency exchange rates were published daily. International trade statistics were available from government sources.